Yeah, friends, so welcome once again. One of the great areas I always love to audit is assets. I remember, let me cite this story or an example with you. When I went for the interview at KPMG, and then they asked me, typical question, to provide audit procedures that would be used in, and all my prayer was, they should say assets. And they mentioned assets. And I really articulated. And the audit partners were like, it's like we just gave you what you wanted. And I said, yes, that's an area I really love. So asset verification or asset audits is quite an interesting area. It opens your mind to various dimensions of the accounting profession. You are getting leases over there. You are getting financial instruments over there. Okay, IAS 39. You are getting IFRS 16 leases, or then it was IAS 17. You are getting PPE there, okay? IAS 16, PPE, you're getting goodwill, IFRS 3 over there. In fact, sometimes you most likely even get a business combination, IFRS 10 over there. So it opens your mind to at least a minimum of 4 to 5 accounting standards. Inventory is even there. I've not even mentioned that, okay? IS2, you find it there. So it opens your mind to a lot of accounting standards and helps you to measure and recognize these areas. We have accountants who specialize only in PPE. PPE accountant is there, receivables accountant is there. So if you're able to audit assets well, you can fit into any organization's key areas, core functions, and you will work till your own great satisfaction. Okay, we're moving on to part 2 of where we were, and then we'll look at it. So we ended at the audit procedures on presentation, the management assertions. Now we're going to look at additions and then disposals, okay, then see the income generation on that aspect and see how we can audit them, okay. Where possible, I'll take you through some basic accounting standards and requirements, okay. So for any additions or disposals which are made in line with the assets, confirm if these additions were authorized by the board. Now, those with purchase, check the purchase agreements, the contract we've signed. If it's a lease assignment or lease documentation, just check and see. The amounts which we've capitalized, of course, once you buy them and per the company's capitalization policy, verify that the amounts capitalized conform with the costing records, okay, the cost of the items. Sometimes we buy items worth 1,000 and we capitalize it at 7,000, trying to bring in some incidental expenses which should have been written off. Okay, some people just bring in like legal charges and they tell you, well, the legal charge actually facilitated acquisition, but is it really true? And they capitalize the expenses. So check those ones. Review records and agreements related to any assets we have disposed of, and ensure that we've properly accounted for these and we've disclosed them correctly in the books. Now, check for these patents. No, patents are intangible assets. Review their sales, any sales returns and statistics to verify that how reasonable are the income from patents, from licenses, from franchises and trademarks. Check. Okay, so you see McDonald's, you see KFC. These KFC and McDonald's and name them belong to individual companies or individual organizations, but they are using the name KFC as a franchise or McDonald's as a franchise, and they pay some franchises or royalties, let me put it that way, to the real KFC or McDonald's, okay? So check whether it is reasonable, the income generated from it, especially if the company has a franchise or alliances they've given out. Recently, you would have heard that one of these guys, Moderna or Pfizer, is suing the other. I think Moderna was suing Pfizer or Pfizer was suing Moderna, I've forgotten, that the other person used their technique, their technical know-how, their patent to produce the COVID vaccine, and they are suing them millions of dollars, okay? So check all of those things to see whether really it makes sense. Any audited account of the licensees, okay? So Check those ones. So if McDonald Glasgow is a licensee of McDonald USA, check, and you're auditing McDonald USA, check the licensee, the franchisees audited accounts to check out whether one or two items are not in place. Key audit points. These are assets, and per definition, we expect that future economic benefits will flow to the company. Recognize where these economic benefits will be coming from. Assets with finite lives should be amortized over that life. It's easy, like depreciating an asset with a fixed lifespan. Okay, if it was something, like I said, people want to recognize an expense as an asset. But if it was originally recognized as an expense and it was not capitalized, then we should not reclassify it as an asset. No, we shouldn't, okay? But if assets are internally generated, they should also not be recognized. We'll come to this. I'll look at the last aspect again. We'll come to this, but let's move on. So sometimes we build assets in-house. We generate in-house goodwill, some in-house assets we generate. Listen, we can capitalize this in line with even IAS 38, okay? Especially for in-house patents, in-house goodwill and copyrights, brands that we generate, intangibles, let me put it that way. Check accounting records for correct allocation of the cost and appropriate costs which have been allocated. And this you would want to do. Ensure that it matches the criteria. There are 6 criteria under IAS 38 for those intangibles which are built in-house. Before I come to that one, also confirm that there's a budgeted revenues and costs associated with it, and review calculations of future cash flows. These two, review budgeted revenues and review calculations, looks more like the E within the last criteria under IAS 38, okay? Now, what are we trying to say over here? Under IAS 38, we have 6 criteria. We call them, we give them the mnemonic pirates, like Pirates of the Caribbean, Johnny Depp, okay? So the P tells us that is it probable that we're going to get future economic benefits, cash flows from the company, from the assets, okay, that was generated in-house. If yes, yes. It means our first criteria. I, do we have the intention to complete the asset and also to use it to generate future economic benefits? R, pirates. R means, do we have the resources available to complete it? A, do we have the ability to use the asset and to complete it? Okay. T, do we have the technical resources, technical know-how, expertise to complete it, to complete what we are building in-house? And E, can the expenses associated with it be measured reliably? And I would always try to knock it against the reviewing budgetary costs and revenues and the calculations of the cash flows. All right. Check for amortization. Once again, we must immediately, once we've capitalized it, we must immediately amortize this intangible, right, from production. And we must charge it systematically. Because some people would want to wait till the asset is fully completed before they start amortizing. No, once you start production. Okay. All right, so there are always tests of controls we can conduct over these assets. And normally we would look at authorities for purchases and sales of these assets. You could always apply your SPAM, internal control activities, you remember them, on these assets as well. You could also consider the registers, fixed asset registered, reconcile them with the nominal accounts. And then check control over receipts of proceeds and income from disposal of these assets or from revenue generated from the use of these assets. And check safe custody of the title deeds, who is actually keeping them, and whether we've correctly disclosed these assets in the accounts. Now, a little literature on leased assets. Leases have become complicated in recent times. In the past, we had IAS 17 covering leases, and it would normally try to split leases between finance and operating leases. We know what finance lease means. Operating lease means you're using the asset, it doesn't become yours. At the end of the day, you turn it back to the owner. Finance lease, it becomes yours at the end of the day, okay? So there's been a lot of complications and confusions surrounding this. So we introduced IFRS 16 leases. to take out this confusion. So now, we normally will not have the split between operating and finance lease. We have this de facto presumption that all leases are finance leases, okay? So here, it tells us that, listen, IFRS 16 tells us that a lease is a contract or part of a contract that conveys the right to somebody to use an asset for a period of time in exchange for consideration, okay? If you subject this to academic arguments, you realize there are a lot of weaknesses in this definition. You cannot just use this definition to mean that everything is a finance lease, but we are not dealing with academic constructive analysis of this statement, okay? So now under leases, you would hear right of use asset. Simply what we are saying is that you have the asset, you have the right to use it. It's still an asset, it's a debit account, it's a debit balance, okay? Companies who are using the UK GAAPs and those who are using the IFRS standards, listed companies with their subsidiaries, they go through lots of restatement of their account balances to ensure they conform with these leases. So two main standards which normally keep changing, IFRS 16 and 15. 16 leases, 15 revenue from contracts with customers. They are always being changed every now and then because developments coming up shows that, I mean, these guys can be troublesome. So we must always update them to meet the current trend. So, like I said, with the calculations, they could be complicated. We are not dealing with this calculation. But two things I want you to know here. Under leases, we capitalize, okay, the present value of the lease payments. Now, you could use two approach. Either you show the ROU asset, right of use asset, or the leased assets on a separate line in your balance sheet, in your statement of financial position, or you include them in your PPE as a block item. If you include it as part of the PPE, then in your notes to the account, you must clearly show what goes into the PPE. Even on a separate line, you must still show what goes into it. Okay. Yes. So I'm gonna leave it here. Any lease comes with obligations to pay something. Now, the significant effect of IFRS 16 will be the disclosure of the lease assets and its concomitant financial obligations, which goes to the lessor, the one who leased the asset to you. If a lease as item is within 12 months, we don't worry ourselves classifying them. Within 12 months, you pay it off, okay? And if they are low value assets, normally around 3,000 or below, we don't normally worry ourselves with disclosing them as separate lease items and then the lease liability we are supposed to pay. No, we don't worry our head over that. Okay, I want you to take note with the second paragraph here, okay? Companies with material off-balance sheet leases, there is significant changes to their key financial metrics. Now, you would have remembered from your basic or previous studies in accounting, whether basic accounting 1 or financial accounting 1 or 2, financial ratios, you know them, right? Now, companies with significant off-balance sheet leases always have changes to these ratios. In your exams, you will most likely be asked to do a financial analysis, okay? Let me put it this way, an analytical review. In the class test, we actually allowed you to, we did it for you, and then we asked you to write your audit risk and audit procedures. In planning for the audit, it's audit planning that we tested you on. Now, we want you now to plan it yourself, and then you use it to do the rest. Okay, so you get it. So don't forget your leverage ratios. Leverage ratios, we sometimes call it the gearing ratios, okay? The debt ratio or the long-term solvency ratios. You know them. You know them. The current ratio, talk of the, your current ratio, your asset turnover ratios, interest cover, EBITDA, EBIT, earnings before interest, tax, depreciation, amortization, allowance, earnings before interest and tax, operating profit, net income, earnings per share, return on capital employed, return on equity, and operating cash flows. Remember them. Remember them. So companies with significant off-balance sheet leases would always have some significant changes to these metrics, amongst others, okay? These metrics, these financial ratios. Intangibles includes development cost, concessions, patents, trademarks, licenses, franchises, and goodwill. Let's look at this briefly whilst we wrap up, okay? Goodwill will normally be captured under IFRS 3. You know how to treat it. It will also pop up under IFRS 10, business combinations, because we get them happening over there. You know, the interesting thing about goodwill, when you read the IFRS 3 and IFRS 10, if we generate goodwill in-house, we don't capitalize it. But when we are disposing of the company, or when it is being acquired as a subsidiary, it is recognized. What we did not, the purchase goodwill, which we cannot recognize, will be recognized by the parent company. The idea is that they are able to measure it reliably. And again, when you subject this to academic discussions, you realize that there may be lots of weaknesses associated with this. But for now, we'll just take it as given, all right? We'll take it as given. Okay, so development costs under IAS 38, okay, patents will also fall under IAS 38. The same story occurs, key audit points, like we saw earlier. Check, would there be future economic benefits flowing from these intangibles? And if they have finite lifespan, amortize them over the finite lifespan, okay? If it was originally recognized as an expense, don't risk reclassifying it as an asset. And any internally generated assets should not be recognized unless they meet the pirate criteria, okay? Probability to generate future income, intention to complete it and use it, okay? Resources available to complete it, ability to complete and to use it, technical feasibility to finish and complete or use it, okay? And then expenses being measured reliably. So research normally helps us to acquire new knowledge. In fact, any cost associated with research, you expense it. Check, did they expense it or they capitalize it? Development, yes, where we are applying the research findings to develop new products or improve products. Do you know the number of companies which researched into bringing out vaccines for COVID? Many, we can't count them. But how many actually came out with vaccines? So you don't have to recognize research as an asset, but the development aspect where we apply the learning points. Okay, and again, remember, they must meet the pirate criteria, okay? So uphold an asset as an asset if they demonstrate tech and feasibility for commercial application. They will produce tangible economic benefits. We can sold it. It can be sold as it presently stands, and whether there are sufficient resources to complete. The same pirate criteria keeps popping up here, okay? Development cost, same pirate criteria comes in here, okay? So project completion must be technically feasible, the T under it, okay? Business intends to complete it and has resources. The R is in, the intention is in, okay? The R and the I is in. Business must demonstrate there's market existence for the product, probability to generate future economic benefits, okay? Only development costs are allocated to projects, not the general overheads, not the inefficiencies or losses, only the development cost. Amortization must not exceed 20 years for any internally generated asset which we have capitalized. Impairments of value must be considered, okay? And brand values must be, brand valuation must be made by competent. So I can see BUI, that's why I paused. It should be BY. So brand values must be made by competent valuers. Now directors just guessing, and it must be amortized over a suitable time period, okay? And accounting policies which we used should actually be disclosed fully, okay? Audit there whilst I easily change this one. All right, okay, so and the accounting policies we used must be fully disclosed. All right, now we wrap up, finally, we're wrapping up soon, okay? So check it against IAS 38, look at their useful life. Any purchase goodwill must be amortized over its useful life, could be short, okay? And the impairments of values must be recognized once we show it. And like we said, directors should not just guess, it should be actually something we can get a competent valuer to value it. Goodwill under business combinations, you meet it, you do it in your next term where you're doing FA3, okay? If I'm there, I'll be teaching you. Maybe I'll be teaching you. I know some of you don't want to meet me, but hopefully you'll meet me again, okay? You love me. I'm a good person. I'm not a bad person. All right, so goodwill, agree the consideration to sales agreement confirm reasonableness of the assets values acquired, check calculation of the goodwill, check that it does not include any purchase goodwill, and review amortization if it has a finite lifespan. Otherwise, look for impairments, okay? And who valued it? Is it reasonable? Okay. Yeah, compare impairment review. We normally do not amortize goodwill nowadays. We impair it per IFRS 3, IFRS 10. Finally, we look at investment. These are cash. Okay, we normally plug them for capital growth income generation schemes. And of course, IAS 39, financial instrument, measurement and recognition can be complicated. Nobody will test you on this, okay? So, but we want you to know the valuation rules of IAS 39 will apply. Initially, look at the cost and then subsequently consider the fair value, okay? Because that's investment. So the fair value on the market could always change. Impairment of value should be recognized, of course, it could drop. People who invested in the oil blocks had their investment impaired during the COVID time. Today, it is rising, okay? Loans held to maturity investment, we must remeasure them at amortized cost. And any equity investment which can be easily valued, should be recognized at cost. Okay. All right. So, like I said, consider this in light of IAS 39 financial instruments, measurement and recognition. You find same under IFRS 13. Okay. And normally, when you have a company showing you investments and or other cash equivalents on their books, you must check their existence. So always remember the management assertions. Do they exist? Can I validate them? Is it accurate? Has everything been included? Do they really own it? Okay, so check the existence with documentations on stock exchange listings, with the company's house registry, and check, okay? Company's registry, not company house registry, okay? Confirm ownership with certificates from third-party confirmations. The banks could always give you a confirmation to that effect, okay? And this one, I wouldn't really worry my head. If you look at the rules for measurement of value under IAS 39, you get these things over there, okay? Financial assets at fair value through profit and loss. We're looking at held to maturity investments, loans and receivables. And available for sale financial assets. For those ones with fair value, we're looking at those amortized costs where we use the effective interest rate method. And then we look at amortized costs using effective interest rate for the loans and receivables. And then again, fair value for any available for sale financial assets. Okay, we're not doing IAS 39, so I'm not dwelling much into this, but consider most especially checking their existence, their ownership, okay, and how accurate they have been valued. Very important. I leave it here. There is a detailed ACCA pass question on page 270 to 272 on Megatron and Poseidon. Very important for you to review it. Very, very important for you to review it. Okay. All right, I end here, my good friends. What I've realized is that, and I must admit, let me just plug in here. Many of you are not engaging with the materials. I keep tracking, and many of you are not engaging. I can't do anything about it for now. Where I have to refer those of you who are not engaging to the engagement panel, I'll have to do it. But I'm hoping that you sit up and then you engage. Just a few people are engaging. It's so sad. It's so sad. In fact, with the class test video, the preparatory slide, and then the video I did, I was expecting 143 people to engage. 143 people to engage. And out of the 143, 33 engaged. In fact, out of the 33, when I dig deeper, I just want to do a small calculation. When I dig deeper, there are people who have subscribed to my YouTube channel who are watching the videos. They are not part of us. And roughly about 18 or 15 of them out of the 33. So if I give them the lowest 13, let me say 13 are not, okay. It means 20 out of 143, just 14% of us, just 14% engaged with the materials. And that was a material, I mean, normally we shouldn't have prepared it, but I went the extra mile to do it. So anyway, that's me. I've done my part. You do your part. You must do more of the reading, more of the engagement. And I'll prepare what I have to prepare for you to pass, okay? So take it easy, and you'll be fine. I'll see you when I see you. One day I'll see you in person, okay? Bye for now.